Feasibility Report, California Wildfire Risk Mitigation. Introduction. Wildfires in California have become more frequent in the last decade due to factors such as climate change, drought, and high temperatures. These disasters have cost billions of dollars, showing a new vulnerability in insurance. Millions of homeowners are inadequately insured or uninsured. Cal Fire 2023 stated that California endured 477 wildfires that burnt over 320,000 acres, highlighting the effects of this disaster leading to property damages and volatile financial situations. This means that there are many homeowners who are not adequately protected due to the following reasons: increasing premiums, policy cancellations, and policies whose terminology is not properly understood by their policyholders. According to the National Association of Insurance Commissioners (NAEC) 2022, approximately 62% of homeowners do not possess adequate insurance to replace a destroyed house. The calamity has resulted to homeowners seeking help from federal funds, which hinders the recovery process and adds burden to essential services. Purpose of the report. This paper analyzes the feasibility of introducing legislative changes, financial literacy projects, and technological advancements necessary for making wildfire insurance more accessible and transparent. Reason for the report. Insurers still pull out of the high-risk regions while homeowners grapple with the soaring costs. This is why California needs to intervene and support insurance consumers, yet ensure the stability of the market. To address the problem of underinsurance that renders those affected by wildfire disasters penniless, a comprehensive solution suggests multiple solutions. Audience. This report is intended for a range of stakeholders in California's wildfire insurance market. The regulation of insurance is an intrinsic responsibility of California policymaking with key stakeholders, including the California Department of Insurance and legislators. Insurers can influence ways and means of protecting homeowners while at the same time avoiding foul play that makes them go down. The National Association of Insurance Commissioners (NAIC) and the Federal Insurance Office monitor industry practices and make sure that they are not overcharging or disguising certain policy provisions. Homeowner and consumer organizations are also important because they are on the receiving end of rising premiums, policy cancellations, and underinsurance. As homeowners become more informed on matters concerning finance, they will be better placed to make sound decisions, especially concerning the perils facing their houses in the event of wildfires. Finally, insurance organizations and affiliated companies are important because they have to serve market interests while focusing on financial viability. Future stability of the insurance sector in California will depend greatly on the former's contribution to risk assessment, pricing changes or development, and joint work solutions involving the sector. Summary of the report. This paper examines the main issues confronting the wildfire insurance market in California, such as soaring premiums, policy non-renewals, and open underinsurance. It also looks at the possible measures like changing the policies that regulate this market, the campaigns meant to raise awareness among consumers, and how to apply technology to better understand risks and give accurate prices. Furthermore, challenges involving the implementation of these solutions and their costs, in terms of resources required and efficiency, are also considered in the report. Lastly, the insurance policies, along with consumer protection, should be reinforced for making the insurance market more efficient and viable for homeowners in California. Background on the wildfire insurance crisis. California's disastrous wildfire frequency and intensity have significantly impacted both homeowners and insurers in terms of skyrocketing insurance premiums, increasing policy cancellations, and reliance on emergency coverage. Premiums for home insurance have risen between 200% and 500% over the last few years in the wildfire-prone areas, with estimates showing that an average homeowner paid more than $3 $0.000 every year for the policy. California Department of Insurance, 2023. These costs have become almost unmanageable for many homeowners who are forced to turn to the California FAIR Plan, the state-sponsored high-risk insurance program that is already 70% bigger than before. Furthermore, leading insurers such as State Farm and Allstate have stopped underwriting new policies for homes in California due to high levels of wildfire threat. Between 2019 and 2022, more than 350,000 homeowners saw their insurance pulled by their companies in high-risk areas due to reshuffling. Even those who manage to have coverage are not fully protected, since policies cost a lot of money and have high deductibles of $20, 000, for example, or no cover for wildfires at all. It is quite shocking that in 2020, only 40% of homeowners had adequate coverage against wildfire, which means that 60% could not seek to rebuild their homes after disaster NAIC 2022. One of the reasons for this crisis is therefore because of low awareness among the consumers. For instance, property owners do not know some of the limitations of their policy or the real cost of replacing their homes, and therefore they are over-insured. Moreover, insurance policies contain concealed terms written in legal language. Thus, policyholders find it hard to determine these policies. Another major issue is the high costs of mitigating measures commonly found in homes that would include ember-resistant vents, fire-resistant roofing, and defensible space modifications that are estimated to range from $10, 000 to $50, 000. Overall, these upgrades are often insisted on by the insurers for policy renewal and renewal budget, even more burdensome to homeowners. Lastly, the current volatility in the insurance sector has put both the users and players in a dilemma, since no one knows what to expect in the future. If regulators fail to act, the insurance companies are likely to pull out of risky areas, thus providing the homeowners with fewer and comparatively expensive choices. If no measures are taken to address these challenges, the crisis will deepen and increase the vulnerability of homeowners to financial hardship and destabilize insurance market in California,